Hey guys, it's Nick, and everywhere I seem to go on the internet, every kind of finance site, all I see is Cathie Wood's Ark ETF, Ark Innovation, how much percentage-wise the ETFs are up, how much money is coming into her ETFs, huge record inflows. And seeing this stuff reminds me a lot of the internet bubble and the internet mutual funds that were going on at the time that had the same kind of rock star status of the portfolio managers. And they had their day in the sun like 1999 when they went up over like 170% or something like that. And people were tripping over themselves to give them more money to invest in these things at the top. So this is really reminiscent of what was going on during the internet. So in this video, I want to talk about some of these internet funds, what kind of stocks they held, what happened to their big gains that they had, how quickly they evaporated, and I'm going to compare it to the Ark Innovation Fund, see what's going on there, and take a look at the top 10 holdings and see what they really are, what's their value, if there is any. So here's this article on Zero Hedge talking about Ark funds saw $1 billion of inflows on Friday, and the Ark flagship ETF, Innovation ETF, saw 626 million in inflows on Friday. That is crazy. And here's a chart of the inflows just going back to December 19th. You see there were very little, and now it's just a huge flood of money coming into these things because the ETFs have gone up a large percentage in the last year. So everybody's piling in just like they did during the internet bubble. For those of you that don't remember, during the internet bubble, there was a few mutual funds that were internet-only mutual funds. Probably the biggest one was the Munder NetNet Fund. And it was only around a few years before it really swelled up in their assets under management because of their fund was going up huge returns. I think 1999, it had a return of something like 175% and 80% in the fourth quarter of 1999 alone. And so this is what their growth in assets looked like. In 1996, they had $10 million in assets under management. By June of 2000, they had almost $11.5 billion in assets under management. So let's see what $10,000 invested in the Munder NetNet Fund looked like. Somewhere around 1996, you started with 10,000, and by 2000, you would have more than $80,000 or 8 times your money, blowing away the S&P 500 in this red line here. But you see, not even 2 years later, you're back down below 10,000. You actually lost money while the S&P 500 is still chugging along like it usually does. So now a lot of people are going to say, well, those internet stocks, they were just all these fly-by-night companies, and the Ark ETF is real companies, and so they have lasting power and all that stuff. Well, let's look at some of the stocks that the fund had. And so media darling Paul Cook, this is the guy that ran the fund, and he was all over the place, similar to how Cathie Wood is today. And he says he's known for a somewhat diversified investment approach, stretching the definition of a net company to include broader tech plays like Cisco, Oracle, Sun Microsystems, InfoSpace. Okay, these weren't, other than InfoSpace, these weren't fly-by-night companies. These are real companies that are still around. However, even a great company doesn't mean the stock is great. And so let's see what happened to the stocks of these companies after 2000. So the first one, Cisco, obviously is a real company. It was above $80, and within a year and a half or so, it was trading around $10 for something like an 80% loss or something along those lines. Oracle was above $45 and fell to about, what, $7 or so within 2 years. Sun Microsystems isn't trading anymore. It got bought out eventually for pennies of its old high. It was trading around 64 around 2000, and by like 2002 or so, it was like $5 a share. And InfoSpace, which is now Blue Cora, was almost like $1,400 a share. And look at this chart. I mean, this is nuts. $1,400, and within what, a year, it was trading at like $2 a share. So guys, that's just 4 of the so-called safer stocks in the Munder NetNet portfolio. It also had such blue chip at the time names like AOL, which was the blue chip internet stock of the time. Obviously, that thing is gone, dead and buried. And so you see, even though these were real stocks, real companies at the time, if the valuation is crazy, it will go back to reality eventually, and you will not recoup your money for a long time. You see, it took these companies 20 years to get back, and some aren't even back yet. Cisco's not back to its old highs. So just because a company is real, the stock price could be crazy, and you will lose money even if the company does well. So I was curious about what's so great about this Ark Innovation Fund that I keep hearing about and seeing Cathie Wood's picture all over the place. So I actually went into the prospectus and looked at the stocks in there and just did a little analysis of the top 10 stocks. So let's take a look at that. So looking at the top 10 holdings of the Ark Innovation Fund, you see that Tesla is 9%, and the top 10 holdings make up about 45% of the fund. So let's look at the PE ratio of these top 10 stocks, and it's for the trailing 12 months. Tesla, of course, is 1,600 and change, ridiculous. Square is 490. BIDU is only a 23 PE, so not bad. What are these zeros? Or does that mean they're really cheap? No, I put zeros here because these stocks have no earnings. They have no E in the PE. All they have is losses. And that's 1, 2, 3, 4, 5, 6 out of the 10 stocks in the Ark Innovation ETF have losses in the last year. As a comparison, let's look at some other PE ratios of other stocks. Apple 39, Google 34, Verizon 13, Altria 88. Chevron has losses for the last 12 months, so it's a zero really. It has no PE. Pfizer 25, Merck 18. So compare these to these. And what happens when stocks get really hyped and they have no earnings, they only have losses? How do you market them to bag holders? Well, the cheerleader analysts, they no longer look at PEs anymore. They say, don't look at PE ratios, look at price to sales ratio. Well, let's look at it. These are some whoppers over here. Tesla 28, ROKU 36, CRSP 191. So out of the top 10, there are 7 that have a PE, price to sales ratio, above 10. That means for this stock, CRSP, for every $1 in sales they have, investors are willing to pay $191 to buy the stock. That's how crazy this is. As a comparison, look at Apple 7.9, Google 7.1, Verizon 1.8, Altria 2.9, Chevron 1.8, Pfizer 4.2, Merck 4.3. So why does price to sales ratio matter? I mean, you know, the funds is going up. Who cares what these stupid ratios mean anyway, right? Well, going back to Sun Microsystems, when it was at $64 a share, it had a price to sales ratio of 10. And the CEO, Scott McNealy, thought it was outrageous. This was a pretty famous thing he said of his own stock, saying how ridiculous 10 times PE ratio was for his stock or any stock. He said, at 10 times revenues, to give you a 10-year payback, I have to pay you 100% of revenues for 10 straight years in dividends. That assumes I can get that by my shareholders. That assumes I have zero cost of goods sold, which is very hard for a computer company. That assumes zero expenses, which is really hard with 39,000 employees. That assumes I pay no taxes, which is very hard. And that assumes you pay no taxes on your dividend, which is kind of illegal. And that assumes with zero R&D for the next 10 years, I can maintain the current revenue run rate. Now, having done that, would any of you like to buy my stock at $64? Do you realize how ridiculous those basic assumptions are? You don't need any transparency. You don't need any footnotes. What were you thinking? So guys, when you look back on these stocks in a few years, like CRSP, which is like 19 times higher price to sales ratio than Sun Microsystem was when Scott McNealy said, what were you thinking to buy his stock? What do you think is going to happen to these stocks going forward? And so you might be thinking, okay, who cares? What does a 10 price to sales ratio mean? What's so big about that number? It's not a big deal, right? So here he says, interesting, there were 29 stocks within the S&P that traded above 10 times revenue at the peak of dot-com mania. Today, there are 28. This article was written in 2017, and I looked it up, and today there are about 60 stocks trading above a 10 price to sales ratio in the S&P 500. And just to show you what people were thinking back then, Silicon Investor is like going in a time machine to the internet bubble, because this was the forum to be on. And here, the forum on the Munder NetNet Fund, December 30th, 1998, Ed Silverstein says, "This is a very good investment. In my opinion, I personally have invested in a Class B fund a while back and have done quite well. Makes a lot of sense, especially for the long haul." Famous last words. And for those of you who just want to buy the Ark Innovation ETF and not do any research, let's take a look at its actual returns since inception. In 2015, it only did 3.7%, 2016, minus 2%, 2017, 87%, 2018, 3.5%, and 2019, 35.23%. So just because the thing is up 90% or whatever in the last year does not mean it's going to do that every year. But that is what people see, and that is what people think, and that's why they pile in, and that's why they usually pile in at the top of the market, just like you saw with the Munder NetNet Fund of it going from $10,000 invested to $80,000 and right back down below 10,000 within like 2 years. This stuff is going on all the time. People pile in at the top. They don't care about researching what's in it. All they know is they see Cathie Woods on enough TV shows. That's good enough for them. So guys, that's my look at the Ark Innovation ETF and how it compares to the internet bubble mutual funds. There are a lot of similarities, and the biggest similarity is everybody chasing performance and piling in because they saw last year's returns. You see, those returns don't go on forever, but that's what people think, and that's why they're all piling in. And if you haven't figured out by now, I do not suggest buying Ark Innovation or any of these other funds. I haven't looked into the other Ark funds, truthfully, so I don't know. But if it's anything like Ark Innovation, this thing is crazily overpriced. And when it pops, it's going to pop a lot. It's going to fall a lot when it does. So if you want to put a little bit of your money in, you know, that risk is up to you, but never bet the farm on anything, especially something like this with these stocks with no earnings, high price to sales ratio. Just because you see her on TV and in every article and stuff like that does not give it the stamp of approval for a good investment, even if these are real companies. Even if these companies are going to change the world, their stock price could be way overvalued. You see it with Cisco, Oracle, Microsoft. Amazon fell 90% in the internet bubble, okay? So just because it's a good company doesn't mean it's a good stock. So I hope you like this video. I'll see you on the next one, guys. Thanks for watching.